Welcome to The Explainer. Today, we're diving into one of the most tested topics for the CFA exam, credit analysis.
So what's a promise really worth? That's what we're going to figure out today. We are going to decode credit risk models, and I'll show you exactly how the market puts a price on a borrower's promise to pay you back. We'll even build a visual guide you can use for your final revision. Okay, first things first. We've got to clear up a really common point of confusion, something that trips up so many people on the exam. It's the difference between something simply failing and what that failure actually costs you. So think about it like this. Default risk is super simple, right? It's just a yes or no question. Will they fail to pay? But credit risk, well, that's the whole story. It asks, okay, if they fail, how bad is the storm going to be? How much are we going to lose? And when exactly is that loss going to hit? All right, so let's start deconstructing this. We're going to break credit loss down into its three core building blocks. If you can master these, you'll have the foundation for pricing pretty much any risky bond out there. So it really boils down to three key questions. First, what's the actual chance of default? That's your probability of default. Second, if they do default, what percentage of our money is lost? That's your loss given default. And finally, how much of our money is on the line at that exact moment? You nail these three things, and you've got everything you need to figure out the market's price for that risk. Now, this slide is absolutely key for the exam. You have to understand the difference between the probabilities we use for valuation and the ones we use for risk management. See, the actual probability just looks at historical data, what's happened in the past. But for valuation, we need to know what the market thinks right now. And that's where the risk-neutral probability comes in. It's pulled right from market prices, so it already has that risk premium investors are demanding baked right in. And this right here is a massive exam point, so listen up. When you're valuing a risky bond, you're using the risk-free rate to discount its cash flows. Because of that, the probability of default you use has to already include compensation for the risk you're taking. That's exactly what the risk-neutral probability does. It prevents you from double counting the risk or, worse, ignoring it altogether. Okay, so the CVA, this is where the magic happens. Think of it as the total present value of every expected loss in the future. It's basically the market's official price tag for all the credit risk packed into that bond. So, to get the fair value, it's simple. You take what the bond would be worth if it were risk-free, and you subtract the CVA. Okay, exam trap alert. Pay close attention here. They're almost guaranteed to test you on using the right probability. And remember, CVA is the cost of risk, so it always reduces a bond's value. It's a subtraction, not an addition. Oh, and don't get tripped up by this simple trick. They'll give you the recovery rate, and you'll have to calculate the loss given default. It's just 1 minus the recovery rate. Easy points if you're ready for it. All right, so we've got the fundamental building blocks down. Now, let's see how this stuff actually works in the real world. You'll see that the market uses two totally different approaches, and it all depends on who the borrower is. And this split is so important to understand. You just can't measure the risk of an individual getting a mortgage with the same tool you'd use for a giant corporation issuing a bond. It just doesn't work. You need different tools for different jobs. So here's the big takeaway from this table. It's all about that market separation. You've got credit scores like FICO, which are for the retail market. That's you, me, and small businesses. They're purely statistical, just crunching numbers like payment history. Then you have credit ratings from the big guys like S&P. Those are for the wholesale market, corporations, governments, and they go way deeper, looking at financials, the industry, even how the company is run. And just look at this. For your typical credit score, your payment history, literally just paying your bills on time, and how much debt you're carrying, that makes up a whopping 65% of the whole score. It really shows you that when it comes to individuals, your past behavior is seen as the #1 predictor of what you'll do in the future. Okay, but here's a huge difference. A corporate rating isn't set in stone like a consumer credit score might seem. It's more like a living, breathing assessment that shifts as a company's fortunes change. And the tool we use to capture this movement is called a transition matrix. This is a really core concept, so let's break it down. A transition matrix just shows you the probability that a bond with a certain rating today will move to a different rating, or even default, over a set period of time, usually a year. So, for example, let's look at the A row. You can see there's an 87.5% chance it's still an A-rated bond in a year, a 9.3% chance it gets downgraded, and a teeny tiny 0.08% chance it actually defaults. And you can bet the exam is going to test you on reading these things. A classic trick is to ask for the probability of a downgrade to, say, BBB times or lower, which means you've got to be sharp and sum up all the relevant probabilities from the table. So please, don't just memorize what a transition matrix is, practice actually pulling the data out of one.
All right, let's do it. Let's pull everything we've talked about onto one single page. Think of this as your master summary, your last-minute revision dashboard for exam day. Seriously, screenshot this. It has all your must-know formulas, the key relationships you need to remember, and that crucial difference between the two big types of credit models. So structural models, they try to explain why a default happens, linking it to when a company's assets are worth less than its debt. But reduced form models are different. They're more practical, using market data to predict when a default might happen, without getting bogged down in the economic theory of why. So there you have it. When you can connect the dots between the probability of a default, the potential losses, and how we adjust valuations for that risk, you're not just memorizing definitions anymore. You're actually understanding how the market puts a price on a promise. And that, right there, is the heart and soul of credit analysis.